GM, good morning. Welcome to the Milk Road Show, the daily crypto show for people who've mastered the art of pretending I saw that coming. I'm your host, Jay Hamilton. It's Thursday, August the 14th. DATs, or digital asset treasuries, are taking over Wall Street. It's taking over the show. It's taking over everything. It's all everybody's talking about. There's hundreds of them, and there's more launching every day. Each one is focused on a different token. There's a different playbook. And honestly, it seems like you can't even keep track of how these things operate. Where's the signal amongst the noise, and why is all this happening? How does this fit into the overall macro picture of where we are now versus where we're going in Q3 and Q4? And most importantly, where's the edge? What do you as an investor need to know about DATs in order to invest in them safely, and how they're going to impact your tokens as well in order to invest in your tokens safely? So today, we are bringing on Charles Edwards, a systematic macro and absolute return fund manager who specializes in Bitcoin and digital assets. Charles has been on the show before. He's renowned for finding unique insights from his quantitative models using on-chain metrics, macroeconomic signals, technical indicators, all to evaluate Bitcoin, where it's at in market cycles. Today's episode was recorded on the Milk Road Macro Show, hosted by John Gillen, but there was just so much alpha in this episode that I had to bring it to you guys as well. Before we jump in and hear from Charles and John, wherever you're listening, please do me a quick favor, hit subscribe, hit like, give us a review. It really helps us grow this show and make sure that anybody that comes into crypto investing does so in a safe manner. Today's episode is brought to you by Figure Markets. Grow your cash like a bank, no lockups, just real returns. Also brought to you by Nexo, the platform that grows your crypto without locking it away. With that, let's hear from John and Charles.
Thank you so much for joining us, Charles Edwards. How are you today, sir?
Going great, John. Good to be here, and all-time high for Bitcoin as well, right? I think as we're recording.
Yes, sir. Yeah. I was going to say I wanted to be checking the price during this, but I wanted to focus.
I'm not now,
Ethereum
but I was
and Bitcoin. Yeah. Yeah. Well, it feels good to be knocking on all-time highs. Yeah. All right, well, let's take this back from all-time highs. It's 5 years ago, I believe this week, actually, that MicroStrategy, I almost called it MicroStrategy, announced their first Bitcoin purchase. And now there are over 150 different publicly traded companies that have Bitcoin on their balance sheets in some capacity. You've been monitoring this very closely, paying attention to the market as it's grown. Why is this such a popular investment vehicle right now, and what's driving all of this?
Yeah, look, I think obviously there's a big story here, but Michael Saylor and the strategy company he manages obviously has been a huge story for the last 5 years. He obviously was very innovative in jumping in on this early, big believer in Bitcoin, adopting it and utilizing traditional finance markets to effectively arbitrage acquiring capital at low cost or no cost in some cases, and then pumping that into Bitcoin, which historically has a 30 to 40% annualized return, versus debt markets, which might be 5 to 10% in the long run. So he's done that and filled the balance sheet with Bitcoin, and Bitcoin's gone up a lot, and his stock has obviously performed exceptionally, as everyone knows, better than all or most of the S&P 500, right? So people have caught onto that, and I think most people thought it would fail. He was underwater deeply in 2022 when FTX went down, but he stayed strong to his strategy. He proved that he didn't get liquidated as many thought he would. And it's outperformed, almost everything in that horizon in the equity space. And so that success track record of, 4 or 5 plus years, combined with the massive amount of regulatory changes we've seen, I think that's probably the key driver here actually in the last 12 months, under the Trump admin, but support of Bitcoin adoption at the state level, the Genius Act, the end of Choke Point 2, the banking rule, where banks were just basically closed to crypto for several years between 2022 and 2024. There's 5 or 6 major legislative policy changes that have occurred, which have made institutions go, okay, it's here to stay. We trust this, as in Bitcoin generally. We want to have a piece of the pie, and then they see the success of MicroStrategy and they just want to copy that. And obviously, that's seen in the last year alone. We went from 60 treasury companies, and back then really 60 were tiny and negligible and not really doing a lot, and they were mostly miners, to now over 150 actively buying Bitcoin every day.
Gotcha. Yeah, I think it's been really interesting to see this grow. As Saylor said himself, his convertible bonds, his equities have been the most interesting thing on Wall Street, and there's just been a lot of attention and economic energy going into this. How do we see this, or how do you see this playing out going forward? Do you think that there's going to continue to be such a thing as a digital asset treasury company? Like, is this niche going to continue to exist, or are we going to move to a paradigm where just all companies or individuals are in some way holding digital assets, and we just think of them as companies?
Good question. I think it depends on the time horizon. I think near term, we're in a bit of a, if you will, a hype cycle of treasury companies. What I mean by that is, we can go through some charts, but the relentless growth rate on the number of treasury companies, the amount they're buying, they've gone from 5 to 10% of total Bitcoin supply in about a year. These growth rates are unlikely to be long term. If you're we've got 150 public companies around the world buying Bitcoin, and that's oftentimes their only strategy. If we fast forward and we've got 300, 400, 500, 1,000, if you will, at some point the incremental new treasury company is going to find it very hard to compete with the other 150, 500, 1,000 companies in terms of their unique offerings. I think that at some point you have to have more than just, we're going to buy Bitcoin. You have to have something unique. Could be unique access to capital markets. It could just be your regular business as a company is really compelling. So the just pure Bitcoin treasury company cycle, if you will, I think is going to be relatively short term. Could be a year, could be 2. I can't put a number on it, but there's going to be some form of saturation, I think, where, how do you differentiate yourself? It's going to be very hard. So that's near term. So that's, I think, call it 6-12 months, we've got really great upside opportunity in the market because they're buying. We can look at some charts on this, but these companies are buying upwards of 500-600% of the daily Bitcoin supply. So we have a huge supply demand imbalance, which is squeezing price up. And every time that happens, over the next 3-6 months, price usually goes up over 100% on average. So there's huge flywheel effects driving that. But as I said, at some point we're going to get saturation, I think, and then we may see something fall back in the opposite direction. But then if we fast forward even further into the future, the question really comes down to, the value of money and if you think Bitcoin's going to be successful or not. So if you fast forward 10, 20 years, do you think Bitcoin is going to achieve its goals of being, whether that be store of value or a cash monetary system as Satoshi envisioned? And if you do, then I think the answer is yes. Almost every company in the world is going to have at least some exposure to Bitcoin. So that's kind of like the philosophical question of the long run success of Bitcoin as well.
Yeah, I think I agree with that. I think the way Saylor himself, I think, articulated this was like, Bitcoin is either going to 0 or it's going to 1 million. And I think every investor kind of has to decide for themselves which one they believe and then kind of act accordingly. I want to get your thoughts on some critics. I also want to dive into some quants and quantitative analysis and charts. But before we get into that, I want to hear your thoughts on some of these criticisms about digital asset treasury companies, specifically about MicroStrategy. Earlier this week, the What Bitcoin Did podcast put out a debate between Lynn Alden, who's kind of a personal hero, and Andy Constant, who is another great thought leader in the space from a macro perspective. But they were debating something. The topic was, is MSTR, MicroStrategy stock, is it a Ponzi? Last month, there was another debate. Jim Chanos has been, talking about why he is so heavily short on MicroStrategy. And Michael Saylor, when he's asked about this, says that some people say it's a Ponzi. I would call it an economy. So he's compared it to real estate in Manhattan. Why are so many people bearish on these treasury companies, specifically on MicroStrategy? Are they right? Are they missing something? Or is it just a difference of opinion about, is Bitcoin going to 0 or 1 million?
Yeah, like right now I see it more as the whole market ecosystem in terms of treasury companies as more of an arbitrage where so many people in the population still don't understand Bitcoin, right? Like it's obviously much more adopted now, but what's the number? Is it 10, 20% diehard believers in Bitcoin, and they've spent the hours, it could be 100 hours or whatever it is, investigating it. And the deeper they've read, they've realized, yeah, this is going to change the world. And it's pretty rare. I think Saylor said this 4 or 5 years ago. If you actually spend 10, 100 hours, whatever it may be, but to deeply investigate Bitcoin, read a book on it, read the white paper. It's pretty rare you come away and go, oh yeah, you're going to go to zero. Almost everyone realizes, yeah, this is the money we were meant to have, incorruptible, distributed, cap supply, all that sort of stuff. So I think that's kind of the arbitrage right now, is you've got, call it 70, 80% of the world don't get it yet. And they're operating on the traditional finance markets where, debt costs, in the range of 0 to 10%, 5% a year. Sometimes if you structure it well, as MicroStrategy has, you pay no interest on your debt, and you have some kind of convertible option. But if they'd actually spent the time to understand what Bitcoin is and how it's performed in the past, as it is still the best performing asset class every year pretty much, and it's oftentimes still ignored for that. And just how it's now escalating to the government level, implemented, policies are being implemented, regulations are being struck around it. Every big financial asset manager in the world is involved in it. The big banks are now involved in it. And even though you run a couple of years and they were like saying it's a scam or it's used for crime, but yet all these companies, all the brand name companies are in the space now. So it's what they do, not what they say. So I think it's the reason this strategy is done so well for MicroStrategy, or Strategy now, and all these other treasury companies, is because it's an arbitrage of the lack of understanding of Bitcoin and leveraging of those low cost markets versus an understanding of Bitcoin and how it has outperformed everything. So I think that's part of the journey, is that at some point, it might be 40 or 50% of the world is on board with Bitcoin. They're holding Bitcoin, they're invested in it. You're not going to get these massive outperformance of these treasury companies, probably, because again, you're going to have market saturation, but also just the returns of Bitcoin with time will decay when it's a 5, 10, $20 trillion asset.
I really appreciate the insight there. I think what comes up for me when you say that is it's not what you don't know that kills you. It's what you know for sure that isn't so.
Yeah.
And I think there are a lot of people right now in the market who have convinced themselves that they understand Bitcoin and are still on that journey. I want to move now. I have a lot more questions about this, but I want to move now to something you're a specialist on, which is quantitative analysis, data-driven analysis. You've recently published a very powerful tool that offers investors a lot of insights and analytics on Bitcoin treasury companies. I'd love you to tell us a little bit about this, walk us through it, and tell us what have been some of the most important takeaways you've derived from this analysis so far, because I think you're leading the industry on this right now.
Yeah. So Capriole, in short, we've been using quantitative models to manage Bitcoin digital assets for the last 6 years. We've published a lot of them. Many here might know Hash Ribbons, and many others have done. And our charts are being used across many platforms. So we decided to make our own professional platform with our proprietary metrics, but also some others that aren't necessarily ours, but we like and we find high signal. So we're trying to consolidate this to be just a select set of metrics that are really valuable for navigating the market. And then about 2 weeks ago, we launched a suite of Bitcoin Treasury company metrics, because basically, for all the reasons we just talked about and the massive demand versus supply imbalance that these companies are causing, I think this is probably the most important data point to be monitoring this cycle. This cycle being the next 1 to 2 years, probably. The institutional demand is the key factor here. So if we just look at institutional holdings here as a percentage of market, this is probably my favorite chart at the moment for these companies as a high level. Wrong one, this one here, buying. Because this tracks, there's a lot of lines here, so I'll just pause to digest it. But the blue line is basically just the sum of all institutional buying of Bitcoin every day as a percentage of market cap. So you can see right now they're buying about 0.016% of the market cap every day. And that's combination of ETFs and the treasury companies in orange. And you can see the orange is a big driver of the recent spikes up in this metric. But what's really cool about this is the red line is just the amount of Bitcoin it's mined every day from Bitcoin miners. And every time the blue line has gone above the red line, so institutions are buying more than is available from miners, we see a massive supply-demand imbalance and price basically goes through the roof. So we saw that, and this bottom oscillator here just tracks the difference between the red and the blue line. So when it's green, we've got more institutional demand than there is supply. And so, we saw Bitcoin go from 10K to 60K in 2020. More recently, we saw in 2024 went from 40K to 75K under the same conditions, and 40, 50K here to 100K. And this all happens in very short stints. You can see it's 1 to 3 months perhaps. And then again, a couple months ago, we went from 80K to now 120K. So, huge moves are typically 60, 70% plus in the last year, 3 moves of that. And then back in 2020, it was like 150% or so. So, the average move is over 100% if you average those moves. So we're currently in a period where the demand is 600% higher than the supply. So it's just massive. So, anything over 200 to 300%, you've got a huge imbalance. And as long as those conditions hold, you can expect price to go much higher. So for me, this is the most important data point really to be monitoring this cycle, because as long as that imbalance is there, I just think we continue to go higher. If it collapses, that's probably a very big risk off warning to consider, as it has done for short periods already in the last 12 months, and that's been in line with some dips we've had. So, and you have to also remember this is a relatively small segment of the market still. It doesn't consider retail and all the other OG Bitcoin holders. They do, the institutions do represent 11% of market cap now, which is massive, up from 5% a year and a half ago. So it is the most, the biggest, for me, it's the biggest data point, which is driving appreciation and acquisition of Bitcoin. And it's the most important data point tomorrow. So that's why we built this suite of metrics. And there's a lot here we could dive into that help with navigating the risk management at an aggregate level.
Why do people invest in real estate? Because it spits off cash flow. But I'm not here to manage rental properties. That's why I'm looking at Figure Markets. Their new democratized prime product backs your money with real cash flowing assets and returns up to 9% APY. It's the first real world asset borrow lend pool built for everyone, not just institutions. Ready to lend like a bank and get more than the 5% Aave is offering you? Download the Figure Markets app today and get 9% on your idle funds. Go to milkroad.com/Figure Markets.
If long meetings and judgmental bankers are your thing, Nexo's probably not. Nexo is a premier wealth platform built for people who value their time and money. It's built for people who have idle cash lying around and want it to grow fast. Whether it's Bitcoin, Ethereum, or even Forex-pegged assets like USDT or USDC, Nexo offers up to 14% annual interest and access to crypto-backed credit in under 24 hours. Your assets need a platform built for growth. Join Nexo.
Yeah, so this is really helpful, really powerful. I think a lot of investors this cycle have been looking for indicators to sort of help them get their minds around the changing market dynamics, the changing market participants, and to really kind of like get a look at like, okay, are we going up? Is there more buying pressure? Where is it coming from? So this for me was really helpful to get a look at this. I want to go back to a couple things you said here. But you said as long as those circumstances don't change, in other words, as long as demand is outstripping new supply by 500-600%, obviously the price is going to continue to go higher, as any first year economist can kind of tell you, right? What in your mind from a macro perspective, this is Milk Road macro, what in your mind from a macro perspective is driving this institutional demand? Because the chart isn't always at 500 or 600%. It seems to be, it's materialized, in more recent days. What are some of the key things feeding into keeping that high like that, keeping that demand so strong? And how do you see that potentially changing in one way or another, or being sustained? Like, how does that play out?
Yeah, I think the main factors are what we've already touched on. So you had the huge success story of MicroStrategy the last 4 or 5 years, where they've outperformed everything. They're arbitraging this, 30 to 40% compound annual growth rate or CAGR for Bitcoin versus the low cost of the debt. They've proven it's sustainable long term because they survived this 80% drawdown. So people that can replicate that are hoping to see something comparable or near the performance of MicroStrategy. And a lot of the companies adopting this method are ones that have been in a big decline typically, or have not been performing well in their own industry for the last few years, and they see there's an opportunity to add shareholder value. So that's the one key driving factor of interest. And then it's also just a narrative and a story that's come to its time in the sun. And a big factor for that is the other elements we touch on, the legal and policy changes that have happened under Trump. So our company, for example, was debanked 3 times for no reason between 2022 and 2024 as part of Choke Point 2.0, where the Biden admin was cutting off all banking rails. So the capital was just not able to flow into this industry. Unless you're a tier one like Coinbase, it was basically stopped. So this model would never have worked in that environment, which is also where you see a flat line in the the institutional growth and share of market through that period as well. Then you have the US has added a Bitcoin Treasury. You had the Genius Act enabling stablecoins. You've the US government and White House has officially killed Choke Point 2.0, and you've got in the last week the 401k policy, which allows over 10 trillion of capital in the US to now actively look at and consider buying crypto. You have huge tailwind legislative policy, which is giving comfort to institutions that, okay, we can buy this asset, we can, take part in this, and we see a future in this. And it's, there's a lot more legal certainty that things will be robust into the future. So that's the main, that's probably 80-90% of the whole picture, to be honest. The other factor you obviously have is liquidity, right, into the market. So the global money supply, for example, has been in a massive uptrend through basically all history, but especially so, it's the blue line here versus the S&P 500. But it's, we're at $112 trillion in global money in US dollar value. And especially in the last, 3-4 years, it's gone up about 20 trillion, as you can see, 95 trillion in 2022 when Bitcoin bottomed. So there's a strong correlation here with Bitcoin as well. You can look at year-on-year growth of that, so how it's changed over the last year. And if we change this to Bitcoin, we can see a pretty clear relationship that when the year-on-year money supply growth rate is going up, Bitcoin tends to go up. And when it's going down, Bitcoin has more trouble. So just very quickly, the big run up to 2017, there's a correlation between high money supply growth rate, and then it starts to decline. And when it's in negative territory, not a lot happens for Bitcoin. Same thing in 2020. And then voila, we've had it kick off in the last year as well. So in the last 12 months, we're seeing a big influx of positive capital across the world. And that is just basically firepower for Bitcoin to go higher as long as those conditions exist. So that's a big supporting element. But I think the main parts of this story are the success of MicroStrategy in an overarching environment where fiat money is just devaluing every year.
Gotcha. So it's a combination of narrative, of market success, of rising liquidity, and a bunch of fundamental, let's say regulatory, legislative supporting things, welcoming back institutional capital into the space. Very helpful. Yeah, I think so. A question that I had looking at this is like, I agree with your analysis there. I think a lot of the price action is following narrative here and fundamental changes that don't really have much to do with Bitcoin. It's all like exogenous things. In this situation, I've heard a lot of people say the only analytics you really need then for a digital asset treasury company or a Bitcoin treasury company is what is their MNAV, right? Like what's the premium they're trading at to their value of the underlying Bitcoin that they have. So beyond that, a lot of people are kind of dismissive of analytics on these Bitcoin treasury companies. Obviously, you've gotten a lot deeper than that. Tell us about like what people are missing if that's the only picture that they're looking at, and why you think there's value in digging deeper into analytics for these treasury companies.
Yeah, so MNAV is definitely useful. So those who don't know, it's basically the market cap or sometimes the enterprise value. So basically the net value of the company divided by the total value of the Bitcoin it holds. So if it's one, if MNAV is one, a company holds exactly as much Bitcoin as the company is worth. So this can be really useful because if it's a lot more than one, you could argue maybe the company is overvalued if their only business is a Bitcoin treasury company. If it's less than one, you could say, okay, they own, for example, $1 billion Bitcoin, but the company's only worth 500 million. Maybe it's undervalued, and the price of the company should appreciate to match the liquidation value of that Bitcoin. So MNAV is really useful in that regard, and you can use it, to track over undervalue and different trend relationships. But there's also a lot of other valuable data. So we've got this analytics page here with 150 different assets. So just looking at MicroStrategy, for example, there's a lot of charts. So I'll probably delete some as we go. We've got market cap here. You can track. I'll just remove it so there's more space. You can see the company Treasury holdings. You can see how much they're buying every day. This is the green lines here, the green bar charts. Another big factor, apart from MNAV, which we are tracking down here in the blue, so the MNAV MicroStrategy is 1.5. That's market cap MNAV, is the yield. So this here, the green line, is the average yield that these companies generate on their Bitcoin portfolio over the last several purchases. And it demonstrates how quickly they're stacking their Bitcoin. So you also have descriptions of all these metrics here for those who want to have a look later. It's a daily growth rate in their Bitcoin holdings. So at the moment, MicroStrategy is growing their Bitcoin by approximately 0.2% every day. So in a week, they're gaining, about 1% of their Bitcoin. So people look at that and say a high growth rate can justify a high MNAV because they're going to be able to, grow their stack quicker than, and to achieve effectively a fair valuation, if you will. So even though their MNAV's 1.5, because of their high stacking rate, you can calculate what's called a day's cover metric here. And this says that it's 233 at the moment. So in 230 days, so less than a year, MicroStrategy is expected at the current Bitcoin stacking rate, growth rate here, to reduce their MNAV to 1. That's all assuming the price of the asset doesn't move, which of course it will. But it's saying that their market cap today is fully justified by their growth rate in their Bitcoin or their recent purchases within 230 days. So this is also a really useful metric because you can then rank companies by the lowest days cover or highest yield to see which ones are expected to grow their Bitcoin stack quickly and surpass their current market cap. And so you can dive into the analytics for each asset here. We also have price sensitivity, which tracks how the share price has reacted to certain buys over time. And when it's green, it's generally, you get good price appreciation. So that can be a useful filter as well to look at here for MicroStrategy. And then you can, cluster and group the assets into different criteria. So we've got many different options here. One I quite like, taking inspiration from Warren Buffett, is the cigar butts chart. This is basically identifying all of the current treasury companies with an MNAV between 0 and 1. So in theory, if you value it just on their market cap, they're undervalued because their Bitcoin is worth more than their company at the moment in terms of market cap. We'll also be adding debt metrics to this in the future to help get some more insights. But
gotcha.
Yeah, so that's
awesome.
There's different ways of slicing and dicing it, and there's days cover for the same thing as well.
Yeah, I think that's what I wanted to get across to the audience is that there's a lot more to these companies than just one number, the MNAV, right? There's a lot more going on in terms of how they're accumulating more of the asset, how they're deploying it, and each one of these companies has a different strategy. To use a pun, a different strategy for how they want to, outperform and differentiate themselves in the market. So I think, it's a mistake to think that these are Ponzi's, that it's going away. And we'll have to kind of see, how long the demand lasts and who are the survivors, winners, and losers. But yeah, I just wanted to highlight that for the audience. Is there's much more in the data, in the analytics that can inform an investor about these treasury companies other than just the MNAV. We talked a lot about Bitcoin treasury companies. Obviously, there's a huge universe, a galaxy really, of other digital asset treasury companies. Ethereum is getting a lot of attention right now, heat in the market. Tom Lee is aiming to get 5% of the Ethereum supply. Are you watching any of these other treasury companies outside of Bitcoin treasury companies? Do you think you're going to expand these analytics to capture those as well? Or what's your view on that right now?
Yeah, so short answer, yes. So we only added the treasury companies on the website in the last couple of weeks for Bitcoin. We'll probably add Ethereum and others later. But I still think Bitcoin is, if you're looking at it from a macro perspective on the opportunity and risk in the asset class of crypto generally, the Bitcoin one's the most important, because if they turn for the worse or they turn even more positive, that is going to be the driving factor of all capital in this asset class. So if tomorrow Bitcoin treasury companies would decide to start unloading and we'd have different metrics to track the buy-sell ratio and it can flag that quite early on the chart platform. It wouldn't really matter what the ETH companies are doing, I don't think, because at some point it's all going to buckle. A lot of what you learn from navigating Bitcoin and crypto through the years is that capital flows downstream from the biggest market cap assets. That it also applies for equities and bonds. So bonds drive the equities market, equities drive crypto in many cases, or gold. It depends which period you're in, and then Bitcoin drives altcoin performance, etc. So you don't get a good alt market until Bitcoin is in a great strength and breakout like it is today. So that's the kind of aggregate picture. So Bitcoin one metrics here are the most important. That said, Ethereum and others are obviously seeing quite a lot of this as a new movement as well. And it's not just Ethereum; it's the L2s and other side chains and all sorts of things. So
Right. Yeah. There's a lot of them. A lot of people deploying this digital asset treasury company for a lot of different digital assets. To that question, how do you think about just personally or dealing with investors? How do you frame the difference between getting an exposure to a digital asset or to a company that's treasuring that digital asset? Right. So like you could do this for Bitcoin, Ethereum, many others. But how do you think about differentiating those, and what are some of the things that you think are the key things to pay attention to if you're trying to make that choice?
I think it depends what your goals are and the level of you're involved in this, right? If you're deeply analyzing the analytics of these companies, you can find some really, some gold nuggets. But if you're just interested in exposure to Bitcoin or ETH or what have you, you're probably better off going to the core asset and getting involved there, because there is probably, there's more esoteric risks with these companies. You have to think about their debt, you have to think about their core business, all sorts of different factors, which, will they keep the strategy long term? So there's lots of different questions you have to consider. Whereas if you can see that for Ethereum, for example, it's in the last, I think, 6 weeks gone from 5 to 8% or even more. It's basically doubled the market cap share that these treasury companies own. So it's growing extraordinarily fast, and it's a massive amount of buyer pressure, which is a really big tailwind for Ethereum. The easiest option is to identify that and say, okay, we're seeing massive outstripping demand versus supply for Ethereum, and it's even higher than Bitcoin right now. Maybe you should, if you're interested, consider just allocating some Ethereum and then changing your allocation when the data changes. So that's the easiest way of doing it, and lower the risk in terms of you can just look at the aggregate metrics. You can have certainty of what Ethereum, the Ethereum isn't going to, unlike a treasury company, is not going to necessarily disappear overnight. And finally, it's a lower risk strategy for those reasons, basically. Yeah.
Yeah. So every investor has to evaluate this for themselves and to understand the specific digital asset treasury company they're interested in, the asset. Okay, that makes sense there.
The only thing I want to add to that was the liquidity. You have much better liquidity in crypto 24/7. Whereas if you buy a treasury company, some of them are really small market cap, or they're just trading 8 or 9 hours, 5 days a week. Sure. Whereas you can very quickly and easily manage a risk if you're trading 24/7. That's another. It's easy to overlook, but it's a big factor in this market, which moves quickly.
Yeah, and it matters a lot when it does matter. I want to move now to a macro and the larger market cycle for Bitcoin, because I think you've recently made a lot of comments on this that have been fascinating and compelling for me. Last week, I had a great interview with Michael Howell, the godfather of global liquidity from Cross Border Capital, about the current global liquidity cycle. Michael is predicting that this cycle is going to peak sometime around Q1 of 2026. For any audience members who are listening who missed that interview, I recommend you go back and check that out. Michael laid that out in great detail. Bitcoin's price, generally speaking, is going to lag the liquidity cycle 2 to 3 months. That's what we've kind of seen in recent history, at least. That would put the peak of Bitcoin sometime in the first half of 2026. Do you agree with this forecast? Do you think we're going to get this sort of right translated, extended Bitcoin cycle, or do you think this will top out more in the fall of 2025 or go even longer than that? Like, what's your view on this right now?
Yeah, so I wouldn't put a date on it like he has, because I think that's impossible to forecast. But I do think it's a right translated cycle for a few reasons. I wrote a recent newsletter on, it's also on the website for those who want to look at it, with the 4 or 5 main points of why I think it's a right translated cycle. One is what we've talked about a lot today, the regulatory things that have only happened in the last 6 months, whereas in the preceding 2 years, it was a very tough environment for Bitcoin, and that wasn't necessarily the case in prior cycles. The other big factor is the Treasury company flywheel has only really started or really gone exponential the last few months, and as long as demand outstrips supply, you can't really expect a bear market. That could change in a week, and we'll review the position accordingly. But right now, there's big driving factors for a right translated cycle. And then you had liquidity cycles, like this man's talking about, and what we showed on screen. It's just gone positive quite late in the cycle, and every time it's been positive, Bitcoin's had great performance. So I'm a big believer that the best of the cycle could well be ahead of us in the next months. I don't want to say 6 months or 2 years, because this could, if it's, Bitcoin's moving a lot slower and more efficiently these days. We haven't had any kind of parabolic phase like we haven't had in prior cycles. So this could continue for a long time, but it could also change very quickly if, liquidity was to dry up on the macro scale across the world, or if treasury companies were to hit saturation like we talked about, and potentially start unwinding positions. So there's many factors to monitor. So I kind of tracking this whole cycle generally on a daily basis based on the data available. And right now it tells me the outlook is extremely positive, but I know from this industry things can change quickly, and I'll be open-minded to adapting that view at any time. But yeah, my base case, if I had to put a number on it, is we've got at least probably 6 months of really strong opportunity. But I would want to, review that on a day-to-day basis.
Right. Yeah, I think that makes a lot of sense. That's kind of my attitude about this too. I can definitely see a case for a more extended bull run, as you said, a right translated cycle. But I could also see a scenario where we get, this parabolic market exuberance in the fall, where everybody piles in and thinks the top is never going to come, and we get a blow off top in the fall. So it really is follow the market day by day and be open-minded, right? Don't be dogmatic about what must happen. So I appreciate that insight and that outlook for the audience. Do you think that the 4-year cycles for Bitcoin are dead? I think that there's been a lot of debate about this. Some people are saying that, the cycles are going to continue. It's just that what's driving them has changed. Some people say it's a thing of the past and it's just going to be up only forever. Like, what are your thoughts on that?
Yeah, I think I spoke in the last recording with you guys a while back on my thoughts on this. But
this is why I asked about it.
It's a hot topic. It's a good one. I like being agile and flexible and monitoring data day to day, like you just said, is just so important. I think that being dogmatic is a real big risk factor in this industry. That you see people make extreme amounts of wealth in a short period and then lose it all, or lose a vast majority of it, give up on Bitcoin and crypto and just exit. That's happened many times in prior cycles, and then they've missed all the long-term opportunities. So you got to be flexible. You got to manage your risk and look at this day to day. So whatever we project now is interesting and maybe a useful guide, but you should monitor this stuff and understand it yourself. That's kind of the first thing I put out there. But yeah, is the cycle dead? So I think the impact of the cycle is more or less dead. So historically, the Bitcoin cycle was driven by Bitcoin miners, and they had huge impact on supply. On day one, they were all of the supply available, and that's now dropped today to less than 1% of, the annual growth rate of Bitcoin supply is less than 1% today. So less than half gold. So that occurred in the last halving last year when the supply growth rate dropped in half. And since then, for me, that's been the key change, is that the impact on supply is so low. It's now the hardest asset with certainty in the world. So we have clear visibility of what's ahead. We know the miners don't have a great impact on supply. They're not going to be responsible for a lot of the drawdowns and reallocation of capital that we saw through miner capitulations in all the prior cycles. So that's gone. There are still other factors which can drive a cyclical dynamic. Probably the biggest one is just reflexivity. If enough of us Bitcoin OGs or traders and investors think there's a cycle, then they'll act on that, and they're investing and they're buying and selling, and they might take some risk off, and that can in its own way drive a new cycle, right? So I would never eliminate it completely, because markets often move by that psychology and sentiment. And then there's also a whole swathe of data we can look at: on-chain data, MVRV, dynamic range, NVT, for example, which track the relative value of Bitcoin to when it was purchased, or the relative value of Bitcoin to its market transactions. So if that ever goes exponential or hits a euphoric phase, as it has at the top of all price cycles, I'd be much more open to, okay, on a risk-adjusted basis, this is making less sense, and the risk for a cycle top is growing, right? So you can kind of weight and stack all these metrics to help get a picture of where you are in the cycle. Right now, it's super healthy on the on-chain space, on the sentiment space. So I'm open-minded for a less volatility, less drawdowns, and kind of a slower, more efficient grind up, as we've seen in the last couple of years. That said, a big risk factor here is the Treasury companies. I think that while they're the biggest opportunity this cycle in terms of price movements up, they're also a big risk factor in a downward spiral if they decide to unload. So that could be from a few reasons. It could be they take on too much debt, too much risk, and they can't sustain it. It could be triggered by a pullback in Bitcoin, which puts them underwater and shareholders are asking questions. It could be supply saturation because there's just too many of them and they can't compete, and they just start to unwind. And what starts to trickle could very quickly become, a flowing river of capital exiting. So that's why we're tracking a lot of this data in great depth and granularity, and it's monitored 24/7, because it's amazing for the upside opportunity, but it's also a risk factor to consider, especially later stages. So yeah, each cycle we've seen less drawdowns. So they were 90, 95%, and then the last cycle was just under 80%, and it's consistently less and less. I think we can expect that to continue. Maybe the next peak cycle drawdown 60%, for example. I can't put a number on it, but for all these reasons that were just discussed, I think we shouldn't expect 80% plus, pending some new information or over leverage in the whole market across Treasury companies, for example. So it's just really important, as I say, to be dynamic, monitor the data, and not be dogmatic on when things should happen.
Right. Yeah, I think that makes a lot of sense. And I think that this is sort of the perspective I wanted to kind of bring to the audience right now, is like, not to get dogmatic, stay open-minded, keep watching the data, keep watching the tape. Another thing I wanted to ask about before we're coming up on time here, so we'll have to wrap soon, but I wanted to ask about this difference in this cycle of institutional buying pressure, institutional market participants versus retail. I think retail is still here, but they're largely in other assets in the digital asset space, whereas institutions have been predominantly the ones driving the Bitcoin adoption. I don't think we've really seen how they respond in the bear market, right? Like, we don't know if they plan to hodl through that. We don't know if they're going to, like you said, first a trickle, then a flood of people stampeding out of it, just kind of like we've seen with retail, but institutions doing that. Like, what are your thoughts on this? Do you think how do you see that behavior being different? Do you think retail eventually does come into Bitcoin and support those institutions? Or just like, what are your thoughts on this divergence between retail and institutions right now?
Yeah, it's really fascinating how retail seems to be kind of missing out a bit on this cycle. I think there's overlap in how they both behave. So while so many institutions are very dogmatic and are like, this is our strategy, now we're going to do this, I think when they're 20, 30, 40% underwater and their shareholders are all like, what's going on? Let's kick out the CEO, let's do X, Y, Z. That's going to change pretty quickly. So there's going to be quite a few that will at some point give up the strategy. In the long run, as we've discussed earlier, I think more and more companies will do this strategy. So I'm not bearish on it at all, but it just depends on the horizon, and you have to accept that people will be under a lot of pressure with this strategy as well. So that's one element. The other is just institutions in general tend to have a longer term holding periods and investment cycles. So it will take large companies, funds, pensions, multi-billion-dollar entities, like many, many months to make a sizable investment in anything, often multiple quarters. So things go through investment committees, due diligence, they're monitored for long periods of time, and they might go into board meetings, and then they might review it and say, okay, let's discuss it next meeting and see how it tracks. So these things can take 6-12 months to action sometimes. especially if it's a big change like becoming a Bitcoin treasury company or not, that it could take years, right? So they're less likely to puke like retail will and just sell at 4 a.m. in the middle of the night on a perp exchange. So that there's definitely a lot of, that's all in itself is a big reason why we probably won't get the same magnitude of drawdown, the same just absolute liquidation cycles. We saw in 2020, Bitcoin went down like 50, 60% in like 24 hours because of liquidations effectively driven by BitMEX. So those days are gone. And that really protects the downside quite a bit, but we shouldn't expect that they won't unload at certain times. So I kind of view institutions in this space as long-term holders in Bitcoin in prior cycles. So you can track long-term holders based on how long they've held coins in their wallet, and you can see they behave generally very smart. They increase their holdings in the bear markets and they sell down into profit and nearer to the cycle tops. And that's occurred like clockwork every cycle. We're seeing it this cycle too. Uniquely this cycle, we're starting to see growth in long-term holders in the last 3 to 6 months. Again, basically driven by these treasury companies. So I view them as basically a whole new audience of long-term holders, which have just jumped into the market and represent more than 10% of the market now, and it's growing every day. So that's extremely bullish long term, and it will smooth out a lot of the downside volatility even further. So long answer, but basically that those entities will be more long term thinking and limit downside risk quite a lot. And then at some point, retail will jump back in. Of course, I think we're probably entering that horizon now above 120K. We're almost double the last cycle's all-time high. And these headlines and what's happening at the institutional level, they can't be ignored forever, and people are going to probably jump back in at some point.
Gotcha.
Pretty soon.
The risk of puking, I guess, is lower now, and we're hoping that these institutions are hodlers. But yeah, there's always a risk somebody pukes sometime. Charles, I really appreciate the insight, the perspective, and I think as retail does come back in, if they are coming back in, and this is one of their entry points, I really think this is a helpful perspective about having an analytical and fundamentals driven view, being open-minded and not dogmatic about your positions about what must happen, but being open to what does happen and what can happen. Where can we send people to find more of you and your work online?
Yeah, sure. So I'm pretty active on Twitter or X at Capriole.io, where I share charts and data and insights. Obviously, we've got our website, capriole.com, which is the hedge fund there, but also capriole.com/charts, where you can check out all these charts and more that we've discussed and monitor it in real time, set alerts, and be ready for when the data changes.
All right, sir. Well, we'll keep an eye on things, and we'll keep an eye on you and your work. And thanks for coming to Milk Road Macro. Really appreciate it, Charles.
It's great to be here. Thanks, John.
Thanks for joining us, everyone. We'll see you on the next episode.
If y'all are making swaps or trades right now, highly recommend you check out Milk Road Swap. This is a DEX that we built in partnership with Cow Protocol. Why did we build it? Not to make money, just honestly so we could have a place to do our swaps for the lowest fees that we could find. This is the fees on Ethereum, Arbitrum, and Base are only 0.15% fees. This is a huge difference from other centralized exchanges that charge 0.5% or even up to 1.2% fees on their swaps. Also, you can swap on Solana, all at swap.milkroad.com. Check it out today. You won't be upset. And you can join me in my favorite place to make swaps on chain. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.